Have you ever wondered what happens to your money after you deposit it in a bank? Well, you're not alone. Many people have this question, and it's an important one too. Because as it turns out, banks do a lot with your deposit money. First and foremost, they use it to make loans to other people and businesses. That's right, the money you deposit is what allows banks to lend money to others. This means that your deposit is not just sitting idly in a vault somewhere. It's actively working in the economy, helping to create jobs, grow businesses, and stimulate economic activity. But that's not all. Banks also invest your deposit money in a variety of ways, including buying government bonds, investing in the stock market, and making other types of investments. In short, banks make money on the money you deposit. These investments generate returns for the bank, which in turn helps them to pay customers interest on your deposits. Of course, banks also have to keep some of your deposit money on hand, just in case you need to withdraw it. This is known as a reserve requirement, and it ensures that banks have enough money on hand to meet the needs of their customers. What happens if banks collapse? If a bank collapses or fails, the fate of your money depends on several factors. In most countries, banks are insured by a government agency that provides protection to depositors in case of a bank failure. The exact coverage and level of protection vary by country, so it's important to check the rules in your own jurisdiction. However, in general, the following steps occur when a bank fails. The bank is placed into receivership. When a bank fails, it is typically placed into receivership, which means that a government agency or another financial institution, like Federal Deposit Insurance Corporation, takes control of the bank's assets and liabilities. Deposit insurance coverage kicks in. If your bank is insured, your deposits will typically be covered up to a certain amount. For example, this amount is $250,000 in America. The government agency responsible for deposit insurance will step in to reimburse depositors up to the covered amount. The bank's assets are sold off. The receiver will sell off the bank's assets in order to raise funds to pay back depositors and other creditors. Depositors may receive a percentage of their funds. In many cases, depositors may not receive the full amount of their deposits. Instead, they may receive a percentage of their funds depending on the amount of money available after the sale of the bank's asset. It's important to note that not all banks are insured, and not all countries have robust deposit insurance programs. In such cases, depositors may lose some or all of their funds if a bank fails. To minimize the risk of losing your money, it's a good idea to do business with reputable banks and to spread your deposits across multiple institutions. To ensure that you are covered by deposit insurance in case of a bank failure,